Good afternoon and welcome to the Dairy Signal. We are back with a market update with Ben Buckner, Chief Grains and Dairy Analyst with Ag Resource Company. I wanted to remind everyone to take advantage of the next hour that we have Ben with us to ask your questions. To ask your questions, you can do so by clicking the three dots on the bottom right of the video screen and press the Ask Question button, fill in your information, and then click Submit. Also, to take your quiz for continuing education credits, a pop-up will automatically come up after the episode is ended, and then complete the quiz and hit submit. And before we get started, we do want to thank our sponsor, Zinpro, for sponsoring today's episode of the Dairy Signal. For over 50 years, Zinpro has been a leader in the research and development of performance trace minerals. Zinpro believes your herd's profitability depends on providing the right nutrition at the right time. Discover their industry-leading tools and solutions at zinpro.com. With that, Ben, take it away.
And as always, it is a pleasure to be a part of this. We don't have a lot of new to report in terms of what's happening now and really the outlook for the next 12 months or so. And I guess like the context is we've got, we're in Chicago, we've got an office in Brazil. We work pretty closely. This morning, had meetings with people from Canada and Switzerland and Ireland together. I had 400 man hours per week trying to see what the future holds for US ag markets. And there's just nothing really compelling today to, I think, change things at all. So the insight is I don't think it pays a lot to be very bearish of US dairy or corn or wheat or soybeans. But at the same time, we've got to see some kind of supply catalyst to see rallies that are lasting in all of these markets in the US and across the world. So that's still our mantra. We want to be prepared, and to be very clear to start this out, we do like monitoring the back end of the class 3 market. $17.50, call it, May onward. I think that makes sense to, at that point, pass some risk off on to someone else, because one of the insights we do have is again, if you don't have a catalyst, we're just going to do this whole thing over again. So you're going to see production growth milk-wise in the US and elsewhere unabated for the next 12, 24 months. So we do not want to let that premium slip away from us. But otherwise, jumping right into it, we've got another month's worth of data. We are soon, not yet, but soon to catch up with US product supply and demand. I think we'll get those numbers next week. But nothing's changed. We're still seeing incentive to grow milk production in a country like New Zealand, where they're still producing a lot. The US is, of course, producing year over year milk unrivaled in the last couple of years. So just an incredible amount of milk being produced here. Same thing in Argentina, even in Europe, which is kind of a surprise. And I just think, unlike 2023, we don't see that changing in the next couple of months. So probably just continue to build milk production. And I do think we have this kind of odd phenomenon, and we do also recommend beef dairy crosses. I think that's going to be a silver lining to a lot of P&Ls in the U.S. And as big as it has become, it really hasn't solved any beef supply and demand issues. Supposed imports from Argentina, they're not going to solve the beef supply issue, and even ending and eliminating the tariff on Brazilian beef completely is not going to solve any issues. So beef prices, we think, are still in kind of this bull market for another year. Cattle prices especially, and until you start to expand the beef cow herd, that is going to be the theme in the cattle and beef market. So I think we've got another 12 months of doing this. And in fact, I think the beef market kind of needs the dairy beef crosses to balance supply and demand even a little bit, and at some point in 2026. So that's the silver lining here. The other silver lining is the feed markets do have a heavier feel today. We'll spend some time talking about the chaos that I think is involved with US and Chinese trade. And is there a deal? Did we get a deal done? What is even China's pledge today? There's a lot more uncertainty. And I guess we, as the analytical community and really the market as a whole, is a lot less confident that we are soon to build upon this relationship with China. So clearing stocks, finding world market share in a market like meal, soybeans, or corn, I think is going to be challenging unless there is a weather problem, and probably unless there is a weather problem somewhere in the Northern Hemisphere, spring, summer 2026. So let's take December class 3, jumping right into milk markets. It looks pretty similar to what it looked like 2 weeks ago. The extraction of premium, we've mentioned this, almost every 2 weeks, but we're kind of soon to arrive at this point where we've got, of course, we can see milk production growing, but per day consumption of dairy products January, February is just pretty weak. And we know that, my opinion at least, is milk markets, US dairy markets, pretty myopic in nature. So you see these big moves, but they're never really seen even 2 and 4 weeks ahead of time. So I think that the market is going to trade what is a totally normal but a guaranteed build in dairy product stocks over the next 3, 5, maybe 6 months. So if we think about what fresh input the market's going to have access to over the next 30 days, 60 days, large milk production, building product stocks, and really no change in production growth elsewhere. So just kind of hard to identify or think about even potential black swan events. What would the milk market see that would sustain the addition of risk premium? And we don't see that coming, at least for the very short term. So we do think that we're finding some kind of equilibrium here. But I guess it's our job to think about what happens next. Is there a turnaround in the markets? And we don't think that that really lies ahead over the next couple of months. So I think milk, the prices you see here today probably stay the same for the next month or so. And I think why we've kind of started to think about Q1, Q2, US and global milk production, and I think it's partially because of, well, cattle numbers, of course, dairy cows, but also the beef market. And so the one thing I think when we're thinking about beef is it is, one of the more bullish markets, bullish commodity markets globally. It has been. And you know that it is a feature of markets like that are very tight in supply, very highly priced, volatility, outsized volatility is guaranteed. And I think that more than anything else explains the last 4 to 6 weeks in the cattle markets. The administration kind of targeting high beef prices, that was pretty dire for those holding long positions. Or would we somehow or another solve the current beef supply issue and bring down beef prices? And so you've got to react to that. But in the end, we've got since caught up to cattle on feed, and on November 1st was down 2% year over year, which has been the case for most months this year. Placements also down. Outright on feed numbers, the lowest in 6 years. And so I don't think that trend changes anytime soon. So it's kind of like the more bullish the beef market, cattle market becomes, the more volatility there will be. And so there will no longer be small moves in Chicago cattle prices. But I do think that this broad up trend line continues. So we're doing beef cow crosses. And I think that is somewhat bearish of milk prices. Maybe for, let's just take kind of broad example, sort of a dairy operation doing beef cow crosses, their P&Ls won't contract at all in the next 6 months, but the price of milk will be declining. That will be offset by demand for cattle and beef. And I think it is that these beef cow crosses, finally we're kind of seeing in the numbers that this is what is behind, or the core of this expansion in cow numbers that we've seen. Just looking at where it is, part of it, of course, was the rebound from bird flu, no doubt, but Texas, Kansas, South Dakota still dominating annual expansion of dairy cows. And I think that's where you're going to see more of this dairy beef cross phenomenon. So that was a long-winded way of saying, because we're bullish of beef prices and beef cow prices, that is going to keep the US dairy herd at something like 9.6 million head. So that kind of provides this base, I think. And it may fluctuate a little more than it has the last 9 months, but it's going to keep this really sizable base of cow numbers, which, assuming average yield growth year over year, going to keep milk production intact. So because the beef market is in this bull trend still, we're going to have a lot of milk production, certainly through Q1 2026. So wanted to paint that when we think about risk, paint that picture. And so the question too that we've got is 2026 milk production. We more or less know, you can't adjust this, the USDA is correct, and it's 231.4 billion pounds. Is growth in 2026 1.3%, about 3 billion pounds as the USDA is forecasting, or is it closer to 4 or 5 billion pounds? So that is another risk. And that's why we think about recoveries and rallies in the market. We know what to do with. Think about the premium structure in the market. It may be too late to do much with, Jan, Feb, March contracts. I just don't think those contracts, class 3, are going to move all that much. But I do think that this premium in forward months does erode unless we throw something at some market, whether it's European milk production, New Zealand milk production, global economic food consumption growth surprises us to the upside. Something does have to change. So I think that's the clearest message that we've got when we think about actionable advice on this episode is think very hard about $17.25, 50-cent June onward class three contracts and just passing some of that risk off onto someone else. Because I do think if you don't see a change, we're going to have an incredible amount of milk in 2026. And I do think we'll clear stocks, but like we've talked before, just that's going to be a function of price. The lower the price, the easier it is to clear excess cheese, butter, powder inventory. So that, again, that is the longer term risk we think. We've also got another month's update. Nothing really changes in Australia, New Zealand, Argentina, this growing, I think, market that competes with the US, at least into, the Caribbean, Latin American powder and cheese markets. I think by February or March, you're going to see kind of a new plateau in Argentina's exports of cheese. Maybe it gets to 250 million pounds in calendar year 2026. So this still lingers in the background, and with respect to the U.S. dairy farmer or milk prices, it's not getting better, maybe getting a little worse, just because we think about this sort of unrelenting production growth outside the U.S. And Argentina is something that we're going to watch. So far, it's been really impressive. They're recovering from kind of the doldrums of production in 2024, but do they get to pre-2024 levels? Find annual growth in milk production at some point, maybe the second half of 2026. So is it a new market that kind of on the margin trends the U.S.'s share of world dairy trade? Also, in the last 2 weeks, we've got sort of more erosion in global dairy markets, at least when we think about the weighted average price at the auction in butter, skim milk powder. So the auction last week, weighted average price was $1.59 per pound, sort of a newer 18-month low, down 8 cents from late November, down from May's peak of $2.08 per pound. And so this thing, once trends are established, they tend to stay that way for months at a time, even years. And so, like we've talked before, I wanted to show this again because it's pretty clear. It kind of makes, if you get production right, you can get global dairy markets, at least the change in value, pretty accurate. So do we have something like you can see here, 2021 or the latter part of 2023, when all of a sudden we flipped from growth to contraction? The dairy market globally immediately adds a premium if that's the case. So the big question to us, and if we change our tune and our strategy of selling recoveries, rallies, forward premiums in the market, we have got to have the idea that these blue bars are below zero, not above zero, or at least closer to zero. And I guess we can't really identify that yet. We'll show this in just a bit, but still today, the farm gate price of milk in New Zealand is close to a record 20 cents per pound. So I don't think that they're losing incentive to keep intact this modest herd expansion, yield maximization, things like that. So it's still all about competition for world market share. So we've got to get rid of 227 billions of this stuff domestically. And we think about fat-based milk consumption, just kind of a burden placed on the market. And I think there is some evidence to suggest that the USDA's projected contraction in fat-based export disappearance may be a little aggressive. But even if that number is zero, the red bar closer to zero in the graphic on your right, you're still at this market that's kind of out of balance. So again, it's all about supply loss to us. Does it happen? And at what point does it happen? And again, to be very clear, we do not think it happens in Q1 2026. I also just wanted to mention, and this is not terribly relevant today, the best we can do, and we'll get new numbers next week, but as of August. And so this just kind of shows you what I think the butter market is doing, and that is just simply reeling from multiple years of near record futures and cash prices. So what that's done, and pretty clearly since the early part of 2024, and especially the last few months, at least ending in August, they're producing 9 to 11% more butter than last year. August's butter production was 173 million pounds. It's up 11%. So you're seeing this growth that you don't see on a consistent basis all that frequently, but it has been happening throughout last summer and probably up to about today. We will see if this changes over the next couple of weeks. But that's kind of the butter market's goal, as you can see pretty clearly. It accomplished the chore of uh, accelerating production, encouraging production, I guess rationing domestic use just a little bit. But now it's flipped on its head. So now it's trying to slow down production, encourage people to eat more meals using butter, more eggs for breakfast, things like that. And so until it finds this base of demand, the butter market is probably stuck. It's going to take time to slow production growth, find demand. So it could be like most commodity markets, this could be a 12, 18-month process of clearing excess fat inventories. It is not all doom and gloom, though, and I do think Class 3 spot, cheese spot, has found equilibrium pricing here. So there is still the risk that I think for a couple of days between now and the early part of April, you will have Class 3 perhaps trading below $15 a hundredweight. The market's probably not going to go up in this 3 or 4 month period, but export demand is still very much intact. We have cooled a little bit from the summer months, but we're just now kind of getting new data after the government's closure. And this is September, which is too far back to really care that much about. But I'll show you why I think this is somewhat important. So in September, all dairy products, 227,000 tons were shipped. It's up 1% on the previous year and a record for the month. Cheese exports still going gangbusters. 53,000 tons of all cheese varieties were shipped in the month of September. That's up 35% from the previous year. There's been no seasonal trend in cheese exports this year. I think we have found new markets. Those markets probably stay with us at least for the next 6 months. And so we're going to make at least more cheese than expected disappear. I think that gives balance to cheese in Class 3 markets, especially if you think about certain the details of whey protein and whey protein isolates. We're having a hard time producing as much of that. Even concentrates, this demand for non-meat based protein does provide a pillar of support along with cheese export disappearance. We also, again, it's only September, but the trade war does seem to be unaffecting U.S. global dairy trade flow. So I think it's just important, something that we've learned again, outside of April and May, kind of the peak of negative rhetoric between the U.S. and China. Those are the only months that they opted to leave the U.S. dairy space. Otherwise, it's been pretty ho-hum. Exports are down a couple thousand tons from last year, but I think that this shows us that whatever dairy China needs, at least in terms of whey and kind of miscellaneous products, they are probably going to stay in the U.S. market. So again, dairy exports kind of a bright light as we think about too much production. We are making a lot disappear in the export space. So why I'm even bringing up September data is that it's still kind of aligning with global cash price relationships. So nothing has really changed. U.S. cheddar has been really, really cheap for the last 12 months. That meant simultaneously and immediately we found this incredible amount of export demand. So importers globally, if you need cheese and you want to save money, you come to the US. That's been the case. Now we know through September. So we look at the snapshot of global cheddar price relationships today, it's still the case and actually getting wider. So we're not this week as focused on the discount, though it is very wide. There is a 55-cent discount in the U.S. cheddar market when compared to New Zealand, and about a 65-cent per pound discount when we compare cheese in Western Europe. But look at the black line and kind of the last data point. So the New Zealand cheese market last week was up 8 cents per pound at 2.10 per pound in the cash market, physical trades. And so the New Zealand market, a pretty incredible dairy exporter, large milk producer, the cheese market there is not signaling oversupply. And so I think that as the U.S. cheese market is very well supplied, we are still going to export, 50,000 tons per month between now and May or June. So again, I think that doesn't provide enough evidence or support for a lasting bull trend, but I do think maybe 15.50, pretty fair price for Class 3 for now. We will see how production grows the next couple of months. And to that end, there is still, again, like I mentioned, there's the risk that at some point in Q1, we do see slightly weaker prices. And again, I don't think rallies have a lot of weight to them. I think they're going to be challenged. It's going to be labored to get the market up. But, bearish trends and prices in butter and cheese. If you squint, the red line's very intense, but we're just kind of following the normal evolution of dairy pricing. And so again, that's why I say we think about the markets being short-sighted, not really seeing past the next 2 months. The next 2 months, very neutral, not much happens. But thereafter, I think we can kind of count on at least some addition of premium in cheese, butter, class three, class four. To what extent, of course, matters more than anything, but I think we're kind of sliding into just a market that's very dull. But again, the risk is what changes? Do we get, again, US production bars at or below zero? Same thing for the world. We're just not seeing a lot of threats. So talked, again, about New Zealand farm gate milk prices being incredibly high. Argentina, this new market that's growing in terms of milk production, having access to just an incredible amount of feed stuff. Wheat crop there, we're kind of getting the details, should have it finalized in the next 2 weeks, but it could be as high as 26 million tons. For context, typical wheat production in Argentina is 16 to 18 million tons. And so you can kind of see in cash markets too, all of a sudden, the price of even milling wheat in Argentina has collapsed. It is below the price of US corn. So I just think the Argentine dairy farmer is going to have access to a lot of cheap feed. Weather's been pretty good. So they're probably not going to slow down in the next couple of months. US as well. I mean, for whatever this is worth, droughts getting smaller, not larger out of the south, outside of the Southwest. And so think about, the central Midwest and New York, the Pacific Northwest, which has been mired in drought the second half of summer, that probably goes away. And even the 7-day, forecast does have a lot of rainfall in places like Idaho and Washington. So I think that may not be an issue come spring for wheat production, feed production, but also I think for whatever is worth, the cows there will not be exposed to incredibly dry conditions. So, again, thinking about what changes the trend in global U.S. milk production, just hard to identify something that does catalyze some major change to the downside. But that's the kind of the segue into the second silver lining for the dairy market, and that is cheap feed. And what's evolved this week is, I think we have always kind of wondered why China has not themselves confirmed something was established in terms of a deal or the framework of a deal in late October when Trump and Xi had their all important summit in Asia. And now we're kind of learning that they keep moving the goalpost of this 12 million ton soybean purchase pledge, and now it's coming out that whether it's February 28th or the end of a growing season, which we're not sure exactly what that means. And China is on track to buy probably 12 million tons in the next 3 or 4 months. We've already bought 5 or 6 million, we think. But it's also, I think we can confirm that the idea that they would commit to buying 25 million tons of US soybeans annually is not in the cards today. So China, again, has not really confirmed anything with respect to this deal, but I do think that beyond the 12 million tons of initial purchases, it's very uncertain at least. So again, the market's kind of losing confidence that whatever Trump and Xi discussed in October will solve feed, soybean meal, soybean price, and supply issues. And so I think that's important when we think about South America's soybean harvest. I think technically there are combines rolling in northern Brazil this week, negligible amounts, but we know that it starts in earnest. Millions of tons of soybeans will be harvested in the next 30 days in Brazil. So this has kind of thrown a wrench, I think, into the meal market rally, the soybean market rally we saw in the month of November, especially. We also just think we're going to have a hard time finding new directional trends in corn. So again, we think corn stocks, the risk is that we're closer to 2.5 billion bushel carryover here. And still the details matter. We're exporting an incredible amount of corn. I think we can kind of back into pretty closely September to November corn exports, physical, will be 840 million bushels. It's a record by hundreds of millions of bushels. Then you think about the market's reaction, whether it's the Board of Trade or basis at St. Louis, Gulf premiums. It just seems like those markets do not care about this. 3 billion bushel corn exports at this point are kind of needed to balance supply and demand. And again, thinking about taking 6 or 7 million acres out of production because we're going to lose wheat, cotton, rice acres. Those go to soybeans. But taking 6 million, 7 million acres out of corn production, you're still kind of left with, let's say conservatively, 2 billion bushel in stocks in 26, 27. So I think there is a scenario, and this kind of makes sense given the historical template, that corn prices, let's use the Board of Trade as a proxy, 410 to 450 for the next 2 years if there's not a supply problem. So kind of be prepared for that. I do think it makes sense to kind of reward corrections with new supply coverage. But you've seen that every time March corn gets to $4.50, it fails. And I think that's because there's just a lot of barley on earth. There's a lot of wheat in Argentina that's priced very cheaply. And then just look at the sort of mentality, psychology of the market. So again, this is our corn in stocks forecast. This is the correlation between season average cash price numbers, stocks to use versus cash prices. And our numbers will not be exactly correct. That's not really the point of this. The point is looking at the slope of this curve. So whether one is bullish or bearish of corn, our insight would be that every side is going to be fighting for 10 or 20 cents. You've really got to pull US corn stocks to use below 10%, maybe even 9.5%, to really embark on supply fears, need for rationing, kind of a new directional market. That's not the case unless at this point you lose 800 million bushels of production or find 800 million bushels of demand. And the market will do that over the next couple of years. We've been here before. We will find that base of demand. There will be a weather problem somewhere on Earth, but it's just not happening, I think, in the short or medium term. And again, I think it's important, everyone's highlighting US corn exports, and they're incredible. But you see Gulf basis this week down a few pennies. So just it's not enough to really engender some kind of change in the structure of the corn market. And we've got to find demand constantly. I think that's what that means. That's what those cash markets are telling us. We think the U.S. corn market's got to somehow get rid of 16.3 billion bushels this year. It probably happens, but it's not going to happen unless ethanol margins are pretty fancy. We are competing with Ukraine, Argentina, Brazil throughout the next 8 months. So it just kind of explains why there is support on breaks, there is resistance on rallies, and we're just kind of stuck here. I also don't think that the corn market specifically kind of falls out of bed anytime soon. And the reason that is because this explosion of Brazilian ethanol production, they've added something like 10 million tons of industrial consumption in the last 18 months. This has been incredible. Biofuel policy. The Brazilian government sees that we have all these soybeans, all this corn. How do we get rid of some of this stuff? And they've really increased diesel and ethanol blend mandates, and that's helped. Even that means very little today, but if you get into April and May, you got to have a big Brazilian corn crop. And so until we get to that point, I don't think the corn market can really fully relax. So keep that in mind as well if we're thinking about spring, summer corn supply coverage. Maybe it's not a 30-cent correction we're waiting for. Maybe it's something like 10 or 15 cents. We're still dealing with a lot of feed in the United States, and it also explains why corn kind of loses its luster at 450 or so basis March futures. Cash markets, we look at kind of ancillary, whether it's hard red wheat in Kansas or sorghum in Kansas, just completely unmoved. So it's telling us, I think those markets, cash markets, are signaling do not plant any more of this stuff, and we still have to get rid of old crop supplies. And so you're still saying, we're not using as much corn for ethanol as we thought. That's because in Texas and Kansas, you're using sorghum instead of ethanol. And I think feed use is in jeopardy of being lowered for corn by a couple 100 million bushels, just because USDA's number, we have not proven we can make that much disappear based on feed and residual. And also, I don't think you're physically feeding much more corn given how cheap sorghum and wheat is across the spine of the central US. And kind of like milk, so we think about what's next for the feed markets. Is there going to be directional change? What will be driving that? And again, I think the biggest thing that's come out this week is US-Chinese trade policy and deals, at the very least, just uncertain again. And we're not sure if there's anything concrete available today, so that's important. We also just don't see much in the way of weather threats in the Southern Hemisphere, South America specifically. Early corn, about 30% of Argentina's corn crop is probably starting to pollinate this week. Soil moisture is abundant, really no issues. La Nina, which is typically very bad for Argentina and southern Brazil, and which is present today, at least in weak form, is not having any impact on the flow of rainfall in that region. So they have avoided that. In fact, it's been a lot wetter than normal if we go back to July 15th in Argentina. And so La Nina ends. Its demise probably happens in the next couple of weeks. And so if we look at that correlation, it just kind of implies pretty normal routine rainfall temperatures in South America. And that's what the 2 week forecasts are showing us. The idea was in these long range model guidance was eventually it's going to get really hot and dry in Argentina because of La Nina, but those models are kind of trimming that back. Normal temperatures, near normal rainfall, La Nina ends. And if, like these forecasts suggest, we are in some kind of El Nino by April or May, you know, never say never. And the correlation between La Nina, El Nino in the US is pretty weak, but on balance, odds are higher that you see trend corn, soybean, and wheat yields when El Nino is present over any other weather phenomenon. So again, I just think if we think about the next 100 days, US drought's getting smaller. I don't think moisture is really going to be an issue kind of planting, and we've got pretty routine, typical weather in South America. This is what that looks like. So if we look at August to November rainfall in Argentina, some spots of dryness, and what you're seeing on your left is about 80% of the corn and soybean belts. For the most part, abundance of rain has fallen. Rain comes back this weekend, again about Christmas time. Vegetation health, the latest we've got is as the middle of November, but this is compared to last year. And so it does seem like, not surprisingly, plants are responding to the abundance of water. So I don't think we're going to have problems in Argentina. In fact, corn production in Argentina could be up 6 million tons from what the USDA thinks. That's not, I think, terribly exciting or even insightful. I just think that given the lack of weather threats, we're going to see a yield like we have the last decade and a half when weather threats are not present. And that's 10 bushels an acre above the USDA's current corn yield in Argentina. And so just an abundance of supply comes back to the feed markets, March 15th onward. So again, thinking about the structure of the corn market and the need to ration feed supplies, just seems that odds are low that that happens, at least for the next 6 months. I do think where downside risk does exist is soybeans and protein meal markets. Brazil, we, like all analysts all the time, debating, fighting, complaining about yields. What will it be? What is your Brazilian soybean production forecast? What is ours, et cetera? But we wanted to highlight here is that Brazil is growing more and more soybeans kind of adjacent to the rainforest biome. And so it's just pretty constantly 85 degrees and it rains all the time. Not every year. There are 2 years recently, 2021, 2023, highlighted here, that it was either very dry in December or the crop was planted late because it was dry in October. You did lose some measure of soybean yields. But for the most part, it's kind of growing slowly, steadily. It's been very consistent. The Brazilian soybean crop, the message is here, it's pretty reliable just because of climate patterns at those latitudes. I think we have avoided issues this year. So kind of a sluggish start to Brazil's rainy season, though not, I think, very material when we think about production. So it rained enough in September. They got things planted earlier on time. That's why we're seeing some harvest or some combines roll across Mato Grosso this week, where the soybeans were planted on September 5th. And then just this incredible performance of the monsoon really since the end of November. So if the forecast is correct, Mato Grosso, which by itself produces 1.8 billion bushels of soybeans, we'll see about 9.8 inches of rain in December. That is about an inch more than average. And this is when yields are determined. This is kind of the August of northern Brazil. So like always, it rains a lot in the month of December at northern Brazil, and it happened again. But what's ahead of us, and I think this is why the soybean market will struggle, given we don't know what China is going to do after the 12 million tons and how fast they get to purchasing 12 million tons, is, again, here is crop progress data from the state of Mato Grosso. Last year, the crop was delayed planting, so it was delayed harvesting. But on average, we're going to be a lot closer to that. So by February 3rd or so, Mato Grosso will have harvested half of its soybean crop. That will be about 975 million bushels, we think, this year. They'll finish harvest by the first week of March. So if you think about the 50% date being February 3rd or 5th or something like that, that is now less than 2 months away. So the South American growing season for soybeans, at least, it just is not very long. It's a short season variety for the most part. So physical supplies will be replenished kind of starting in 35, 40 days, certainly within 50 days. So that's, I think, kind of the new issue the soybean protein meal markets are going to have to contend with. And then even thinking about the arithmetic of soybean supply and demand, China is buying soybeans. They bought more today, they bought more yesterday. Again, we think it's about 6 million tons in total, which any and all demand is welcome. But now we're caught up in export sales through the middle part of November, and nothing has really changed. And we are kind of reporting now Chinese sales during those periods, but we're losing demand from other places. And I think it's like when we talked about, U.S. cheese exports, even in September, but U.S. cheese is cheap today, so those probably continue to be very strong. The early part of November, really after the trade deal was, the supposed trade deal was announced, Brazilian soybeans got very, very cheap. And so you're kind of seeing in the data the details, so we will jump in the weeds here that we're reporting official Chinese demand, but it looks like other countries are moving, getting funneled to South America because it's just cheaper. So in the end, it's still like the challenge we've got is to increase total U.S. soybean exports, increase market share, and that's going to be challenging. I mean, in any year, unless there's a South American threat, and I don't think there is one today. And so if we think about the forward structure of the market, Brazilian beans this morning, you can buy them 65 cents per bushel cheaper for a March delivery. So we've just maybe kind of shuffled the deck chairs. China will buy another 6 million tons from us, but Europe and the rest of Latin America, Asia will start to buy Brazilian soybeans, Feb 1st onward. So the goals that we're accomplishing still looks pretty difficult. And this red line that you see on the left, to justify USDA's annual forecast any year, it needs to be within the yellow shaded area. So pace analysis. If things don't change pretty quick, I think USDA is going to lower its soybean export forecast, maybe 150 million bushels. 80% of that gets put into in stocks. So the soybean balance sheet's loosening, not contracting, and we're just the overall structure of U.S. soybean export demand does not seem much affected by China coming back to the market. But that does help with protein meal prices. So the protein meal markets kind of North American wide have started to extract premium, which may have been kind of added inappropriately during the month of November. I think it makes sense. Yeah, when we are proposing deals with China's coming back to the market, those markets are going to rally. The speculative community was also incredibly short of soybean meal, have been since summer, but especially in the middle of October. And then we've got thawing relationships with China, the market rallies, that all makes sense. We've kind of butted up against this longer term downtrend line. We've lost $20 per ton pretty quick. We still just don't see there being any shortage of protein meal for a lot of reasons. U.S. crush still going to be incredibly large because of cash soybean oil prices. The byproduct, of course, being meal. It's got to go somewhere. We're not really shipping as much as we would like soybean meal into the global market. So probably we're going back to the old range. And I think a scale into new purchases as we move down there. But I do think soybean meal above $300 per ton, in Chicago at least, is a little bit rich. And there's just not going to be any protein meal shortage. We've got to, like corn, make a lot of this stuff disappear. So we think production is going to be higher than USDA projects at 55 million metric tons, an all-time record. So we've got to make 17 million tons of this stuff, 18 million tons of this stuff disappear completely. And I think that will happen just like, dairy products. At what price do we make this happen? It's got to be cheap. It's got to be competitive. We've got to encourage kind of livestock herd growth, if not here, everywhere else in the world. And that's a function of soybean meal prices. Also, the canola market in Canada is having its own issues with respect to Chinese trade, and StatsCan gave us their final crop report last week. This was not unexpected. We did think that Canadian canola production in the end would be about 21 million tons, which would rival 2017's record, but they raised it by more than that. So Canada's canola crop this year will be an all-time record 21.8 million tons. If China does not come back to the Canadian market, there will be more canola crushed in Canada. So I think canola meal will be pretty reasonably priced. And we've already seen it correct in cash markets in places like North Dakota. So there's not going to be any shortage to us of oil seeds in North America, and certainly not of protein meal. And just kind of the final thing, I think, when we think about the oil seed markets and protein meal markets specifically, is that not only were funds in late October kind of pried out of existing short positions, but they've established this pretty incredibly large net lengthen the market. And so the CFTC, like a lot of other government agencies, are slowly catching up. But in the middle of November, managed funds were long 195,000 contracts of soybeans. And that position kind of rivals the most bullish period in U.S. ag, 2020 to 2022, and also the drought of 2012. I don't think this thing is quite peaked yet. I mean, it's not terribly relevant, but this fund length in soybeans probably peaked a few days later at about 210,000 contracts. So a lot of these contracts are underwater, and fund positions don't really matter until they do. But I do think the risk is that because of Brazil's production, the looming Brazilian harvest is that half of this position gets liquidated if there's not a new spark in the market. So just thinking about price discovery, this is kind of now an issue for soybeans and even meal. The meal fund short, which was upward of 140,000 contracts a couple of months ago, covered completely. Funds are now slightly long of soybean meal. In mid-November is about 30,000 contracts, still probably about 5 or 10,000 today. So just liquidation unfold in soybean meal if you don't have some kind of supply dislocation in protein meal markets in the next 3 months. So again, we're not excited to chase rallies in feed markets, I think is the guess. So we still kind of have these three pillars of feed market pricing. U.S. corn crop, just very, very large. To get rid of it, you need to sustain. If nothing else, let's use this as a proxy. Profitable ethanol margins. Ethanol prices have dropped 10 cents per gallon in the last week when we look at the Midwest cash swap market. So corn can't be too expensive to maximize domestic use. It's an incredible amount of wheat on earth. And so Argentine wheat is cheaper than U.S. corn. That's interesting. Probably does trim or provide competition for corn exports at some point in 2026. And also, we think about the milling wheat market globally. If March corn is at $4.60 or higher, you're probably losing corn demand to the milling wheat market because there's a lot of milling wheat that needs to be gotten rid of. Record production this year. And again, I think very simply, South American drought, we've not progressed another 2 weeks. We know December is critical to corn yields in Argentina and soybean yields in Brazil. We're at the middle part of the month, no threats, 2-week forecasts look good. And so I don't think it's going to be a year defined by South American weather adversity. So we still need a demand driver or supply dislocation. And that's kind of true for US ag commodities across the board. So being prepared, still the message. And kind of to summarize, the silver linings here are beef prices. It's going to contribute to farm revenue. Feed costs will be reasonable to cheap. But think about, again, forward premiums, recoveries. Let us lock in margins in the dairy space. So as always, a lot of information. Anything anyone needs, please don't hesitate to reach out, and we will leave it there for this week.
Awesome. Thank you, Ben. I was actually just going to ask what your top takeaways were from today's episode, but you kind of covered that for me already. I'm not seeing any other questions come through. So again, thank you very much to everyone at Ag Resource Company for your continued support of the Dairy Signal. And that wraps up our episode for today. So thank you for joining us, and I hope you all have a great weekend. Thank you.